It's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
What's happening, everybody? Happy Wednesday. T-minus 58 minutes until the Fed. A lot is riding on this Fed decision. We've seemed to see that every time there is one, even though the market's priced in roughly an 89% probability that we are going to have another rate cut. So rather than that little panic we saw back in November with a 6% sell-off, the market's within, about what, 70, 80 points of all-time highs. So what you see on the screen here, this is a look at the SPX this morning and some intraday levels. These are my intraday gamma levels in real time. So right now we're kind of sticky right at the this yellow box here on my screen is a pivot point between positive and negative gamma. So essentially, it's like this big transition between whether the market is going to, sell puts, sell calls, and drift the market higher, or whether the market turns and bails on long positions and just starts to buy puts and drive prices with a bit more volatility. The plus or minus on the day was about 43 points, which means that from the open this morning, around 68.30. We'd have prices at the end of the day. We should see prices settle no more than about 68.75 or so to the upside. So 68.75 should be where the close is, like high wise. It should be no higher than that. And then to the downside around about 67.90. So if we mark those out, again, it doesn't mean it's not a guarantee this happens, but typically within market maker moves and big news like this, usually things tend to stay within the expected move. But as we often see in FOMC, it's very noisy, it's very volatile, and all of the direction today is going to happen most likely between 2 and 4 p.m. So was there a little direction today? Yeah, we're up 15 points. Big deal. But if we're going to have like a 30 to 50 point spike up or down or both directions, a day like today with FOMC is kind of the perfect time for that to be like going both ways. And that does make it really difficult to actually trade. You see all these levels, and basically, there's resistance into these blue lines and there's support into these pink lines, and somewhere in the middle, price is going to figure out how to navigate it. So, my job is to make sure I'm not doing anything silly and taking on unnecessary risk today. I have trimmed a lot of exposure. In fact, I'm probably at one of the higher cash positions that I've been in a while. So I'm back up nearly at 2.9 out of 5.1 million. So 2.9 out of 5.1. I'm at about 57% cash right now. And the running positions that I do have are in really good profit probabilities, like, 85, 90+%, sometimes even, upwards of like 95 to 99.5% probability of profit as I'm rolling in some of these trades at the end of the year. So the trades I have in right now into some of my time decay, I have about $240,000 worth of premium that I've sold over the last, 3, 4, 5 months. That is going to be, a 12-month window. I should expect to see this as long as prices cooperate with the probabilities that I traded. That's a nice kind of way to look at 2026 with some optimism, as opposed to what's the market going to do. So what I did is I trimmed a lot of my exposure on SPX all the way down to any exposure I have in SPX right now. The only risk I would take on is if price is below 6,000. Okay. So 6,000 means that we would have to drop over the next, and I take a lot of these trades to like middle to late January. So we'd have to see the market from current price dump 12.3% in the next like 30 to 45 days. I don't think that's going to happen. And if it does happen, I think there's still going to be some type of reflexive rally. I've been asking this to, if Nick comes on and joins me here, I'll probably ask him, is he a dip buyer? And all of you, are you dip buyers? If the market is down to, let's say, 6,100 or 6,000, would you be courageous enough and brave enough to buy that dip? Or do you think that this is the top and this is the end of times and we're going into a nasty bear market? I'd still buy the dip. I think right now, like any type of correction, the Trump administration and the Fed are going to try to do something to not let this market dump. And politically, it's important to have the market at all-time highs in 2026 going into the midterms. Economically, I know we have some weakness in the labor market. We had PCE that came out last week. The Fed still has about a 1% buffer to continue to cut rates. We're going to have a new Fed chair that's probably on the same page as cutting rates. And we're still going to continue some pretty heavy fiscal dominance. So, I think that it's going to be a grind in 2026. I mean, we could have a blow off top, which would be to the bullish side. The blow off top that pushes up to 73, 74, 7,500 could get really exciting for a lot of traders. The problem is if we go there, I'm getting even more cautiously bullish, right? In fact, I'd be even more like cautious, period. Is not even cautiously bullish. Is if we get to like 7,500 and it looks like this, where we just go through the highs and we don't really stop and we hit 75 plus. I mean, all I'm going to do is draw a trend line like that. And if this thing rolls over that trend line, I am not forcing buy trades because I think this turns into a topping pattern and the risk adjusted returns moving forward. And this is the biggest concern that I see from some of the macro analysts out there is I think I just took a picture of this today. Our forward sales, our price to earnings in the S&P is like one of the highest levels we have ever had. Let me double check the value here. So we are at, let's see, yields versus forward returns, small caps lagging. Only 2 of the Mag 7 companies have outperformed the S&P this year. Valuations. So right now, with the Cape-Shiller ratio in the top 1 percentile of earnings, the only time it's been higher was literally the dot-com bubble. The forward 10-year guidance has the lowest returns expected for the S&P. So if that doesn't make any sense, what it means is because values are so high right now, it is very difficult for the law of large numbers to keep performing at this clip. So it's hard to keep performing at awesome earnings. It's hard to keep beating earnings. It's hard to keep, compounding what these stocks have been doing the last, 5-10 years. And yes, it's been fueled by fiscal policy. It's been fueled by cheap money. It's been fueled by low interest rates, but that's all kind of changing. So yields have a lot to do with this. If yields continue to stay sticky or rise, I just talked to a buddy yesterday that I look after some capital for, and he and his family, they have 3 kids. I think 3 kids under 5 years old, and so they just bought a minivan. He's like, dude, I bought the minivan with as much money as I could put down because I don't really want to have a car payment, and the financing rate was like 8%. He was talking about doing a home equity line to tap into some home equity, and they were the bank was going to let him borrow like 6.5%. I'm like, that's a terrible interest rate. Like, I would never take a line of credit on my house at a 6% interest rate. I'd never want to finance a car at 8% interest rate. I wouldn't want to refinance anything at anything over like 3 to 4%, because that's like your risk-free rate, right? So if I put money in the T-bill and chill it, I can get 4.5% a year, or I do a box spread in the S&P and I can get 4.5% a year. At least there's a way to wash that borrowing cost. Okay. But if I'm borrowing at a higher price, now I need to take on more risk, and you're tapping into leverage, and it's all these things that could be a slippery slope if you're not correct. So point is, yields are still sticky. And, I don't know what this is going to be, but this change in yield with the Fed cutting today, most likely it's like 89% baked in. They're going to cut today. We are still not anywhere near the cut cycle that started in September of 2024. So I still don't know what that means. Does that mean that we see yields go higher, or do we see them just kind of grind here and then slowly continue to go lower? This would be a good thing. I'll put a smiley face here. This would be a bad thing. Okay? Because at least if yields are going lower, then there's going to be some action in real estate. There's going to be some refinancing. There's going to be that air pocket that's needed to keep the runway of cash that so many businesses and households probably need, right? But if yields go higher, everything gets more expensive. And you're just going to continue to push and exacerbate the K-shaped economy. And, assets go up, and it's good to have assets, and that's good for the top of the K. But borrowing costs and refinancing is bad for most likely, small caps, mid caps, and any type of debt restructuring that has to happen here in the next, 1 to 5 years. All right. So I hate to think that it's like this simple, because this is a big unknown. Like, this is a question mark to me. I don't know where yields are going to go. But considering we have cut, and now after today, it's going to be 1.75% off of the short end of the curve, and we are no lower In fact, we're actually higher. That's what's so discouraging about this is we're like 40 to 50 basis points higher in borrowing costs, which is madness. The Fed has cut 1.75% and we're 50 basis points higher somehow. That sucks, right? So this is what we are going to navigate in 2026. Are we going to be sticky inflation, crappy employment numbers, sticky yields, global PMIs rising? That's a tough landscape for equities to do well, right? In fact, I would say that's kind of indigestion for the market. And usually that indigestion for like the debt markets can bleed over into indigestion for the equities markets. And the equities markets is going to be way more volatile, right? I talked about this week as well on TLT. How many of you have TLT in your portfolio? Anybody have like, the 60-40 split? Anybody have some TLT exposure? I bailed on my TLT exposure here. Once we had some decent levels, I did a diagonal spread and I closed out around this high. I think I don't remember the exact numbers on my strikes. I did like a 65 and it was a 65 by 95. And then I lowered that down to 90. And as we ripped up here towards like 89, 90, 91, 92, I just took the profit. So I did for this trade to be up about $35 max credit. I ended up closing this trade out around $30 profit. And my net debit was like, I think 17 or 18 bucks. So either way, it turned out to be a pretty good trade. If I was still in the trade, I would be, down $3-4 from where I closed it. And, more time has been eaten away since this peak was back here in September. That's another that's 3 months ago. So anyway, happy that I got rid of the exposure. I used all those profits to then put in dollar cost averaging positions that I did in Pulver alerts for CEF, PHYS, SLV, GLD. All those are pending orders that, we've had a couple get filled. We're riding CLF. I've got a trade running on silver right now. I've got some pending orders on gold. And I think that's to me a better exposure. I want to have more gold and silver exposure than I do bonds. I'm not saying they're bad, but the idea of risk-free, it's like, I'll show you a risk-free rate. Okay. I don't know if I've shared this before in these sessions, but here's an example of a risk-free trade. If you are willing to allocate some capital and you're looking for like a very safe, like 99.99% guaranteed trade. And I don't know what that 0.01% is going to be other than there's a, delisting of the S&P 500. That's about the only risk you have. So obviously that's probably not going to happen. Okay. But if you go out to, let's go January or December of 2026. So if I go to December, let's go December 2026, let's go January 2027. So we'll go an entire 12 months out, right? This is out 400 days. This is on SPX, by the way. Okay. So right now, if I were to, we're trading around 6850. If I were to do the 6,700 by 7,000, 7,000 by 6,700, this trade is trading for, it's a $300 wide spread. Okay. This is called a box spread. And it's going to cost me about $30,000 because, cash on cash with this SPX, 6,700 to 7,000 is 300 points. Okay. So 300 points times the SPX multiple, you're looking at a 30K position, right? If I've got a 6-figure account or even a 20, it doesn't matter what trade I take as long as I have the cash to cover this. So if I did this for, let's say I have $100,000 and I want no risk next year, then I'm going to do 3 trades, right? 3 contracts. Now this takes up 86K. All right. Now for my 86K, I can make $4,000. I would like this to be cheaper if possible, right? I'd like this to be paying over $4,000. So on that 100K account, I'm truly getting over 4%. So let's do the math on this. Let's say it fills at 287. So 1,300 out of the 28,000. I guess it'd be 28,600. It's about a 4.5% return on my capital. So to be fair, because I'm tying up $86,000 here, if I make 39.45 out of 86,055, there's a 4.6% return risk-free. Okay. So I would rather do this trade and tie up all my capital in my stock and options portfolio than I would buy bonds. Because how many of us thought about this when it comes to owning bonds for the last couple of years? If you go back to a yearly chart, how many of you would have been excited owning bonds in this environment right here? Right? Risk off trading. I'm going to own some bonds. Well, they're declining. I'm going to own some more bonds. They're declining. I'm going to own some more bonds. They're declining. I'm going to own some more bonds, declining. So I don't give a crap if you're in a 4% yield when all this does is decline as an instrument, or all it's been doing is declining as an instrument. So for TLT holders, you want some price appreciation in addition to the yield that you get. If you're truly just buying treasuries, then you hold it to maturity and it's risk-free, right? So there is a difference here. But if you have TLT in your portfolio, you are still subject to volatility, and price can go down against you, which means you're in a price drawdown while you still get a yield to kind of offset it. But 2022 was a terrible market for the bonds, and I certainly would not want to be stuck in a trade that was down. I mean, bonds were down like 20%, weren't they? From this high to low, bonds were down 32%. That's safe haven, folks. No, thank you. So I'd rather do a trade like this. This is a guaranteed 4.5%. If you want risk-free, that's the best way to get it. Right now, even your 1 and 3 month bonds, which the Fed is only controlling the short end of the curve. If you go US 1 to 3 month, the 1 month yield is 3.66. The 3 month yield, let's go 1MY. So there's the yield. So the yield is 3.71 on the 1 year, the 1 month. The 3 month is 3.72. So, 3.7 is what you're going to get in a 1 to 3 month. I am beating that with a box spread, 4.5%. So if I truly want to risk off, that's how I'm going to do it. There's my risk off 4.5% for the year. Now, am I excited about that? No, it's just, that's a good risk-free way of, like, if you're concerned where the market's going, you think that we're going to have crappy returns and a lot of volatility, then this to me is how I go to cash with 4.5%. Okay. So anyway, maybe that's high level stuff. But I think this is the stuff that, I think about. Because I want to be able to take safe risk. I want to make the most money I can the safest way I know how, but not every decision is just like super freaking easy. I mean, I would rather, as a buyer of these markets, I'd rather see another pullback. I know nobody wants a pullback. Nobody wants to see the market dump 10, 15, 20% because it's always ugly and it's illiquid when it happens. And it could obviously get way worse, right? But if there was an opportunity for just a technical trade to come back to here, or we have this broadening pattern where it's just choppy and range bound, if this is distribution that falls, I'm going to measure that move, right? Could this be a bottom? Yes. Could it go lower and come to this outer trend line? Yes. But I would be buying some, selling lots of options as the VIX is up to, maybe 30 or 40. And there's a way to generate income. So I don't need to allocate all my cash. It's like, I'll just try to be tactical and strategic. But I think right now is a good time to be patient, right? So be patient. I've got some cash. Like I said, one of the highest positions I've had, about 56, 57% cash right now, and that's okay. So I am, getting some of that cash paying me unallocated, but I'm using it as, it's liquid and it's dry powder. So if I need it, I dump positions, get the cash back, and I'm ready to deploy. Right? All right. So quick question for everybody here. Are we expecting this market to be greater than, okay, and I'll put these numbers out here. Are we going to be greater than 7,000 into the end of the year, or are we going to be less than 6,500 by the end of the year? And you can also put in between. So give me some comments here, participation in the chat. Are we going to be greater than 7,000? You can type that in the chat. Less than 6,500, or you just type in sideways if you think we're going to be range bound. What do we think? I'm just curious. Okay. In between, closer to 65. Okay. In between the chop. Okay. A lot of in-betweens. I'm surprised that nobody's speaking up yet. Sideways. A lot of sideways. Okay. Finally, we got some graders. All right. Greater than. Okay. Possibly greater than 7,000. Well, obviously nothing's definitive here. And whatever everyone says and we have the consensus, that does not mean that's what price is going to do. I'm just kind of taking the temperature of the audience. I think sideways is a very likely scenario. Going into the Fed today and having some data coming in next week, we had a negative December in 2024. So it would be rare to see a negative December in 2025. December historically is still a very bullish month. So is January. There's good flows in there. Also, there is a lot of like money managers this year are underweight equities and underweight Mag 7. And we have seen some discounts. And the fact that 5 Mag 7 companies, okay, there we go. So somebody's got greater than 7,100. Oh, even more than what I said. Okay, sideways 7,000. Okay, all right. So I got some greater than sevens. It's like, I mean, it's an audience. It's a poll. So it's a mix, right? Let me see if I can find a screenshot here. This is what I thought was interesting. This is the Mag 7 in 2025 year to date. The S&P is outperforming Microsoft, Tesla, Apple, Meta, and Amazon. So I do wonder, from a money manager's perspective, are they going to try to bump into Mag 7 stocks into the end of the year, or are they going to start allowing this rotation to continue? Because remember, if all these companies, and even these companies like NVIDIA and Google at all-time highs or near them, if they start to show signs of weakness, they are still big enough market cap-wise, it will drag the markets lower. I don't think that there is any way to get these to rotate and for money to rotate out of Mag 7 and these stocks go down and inflows go elsewhere. I don't think there's any way to rotate out of these without hurting the overall index. Okay. So I just thought it was interesting that, yes, to date right now, it's like the S&P is outperforming Microsoft, Tesla, Apple, Meta, and Amazon. Now, one of my favorite trades for next year is I'm primarily going to trade. I'll give you a list of what I like to trade. I'm going to trade Tesla is one of my favorites next year. GLD, SLV, my favorites next year. I am going to have some Bitcoin exposure with IBIT, but what I did is I did this in Pulver Alerts. I bought shares of IBIT. I went out to January 2027 and sold an at the money call. And I know that if Bitcoin hits all-time highs, I'm losing out on some price appreciation, but that at the money call was worth 23%. 23%, like locked in. So at the very least, I'm buying shares, locking in 23% return on that investment. If we go to all-time highs, hooray, I can still make 20-something% on that investment. Silver and gold, same type of thing. If I buy shares, I'm selling out the money calls, and I'm going to dollar cost average into more levels to add my exposure. I just dumped a 2 to 3 year long position on gold and silver to take profit this year with well over 100% of each one. So I'm pretty happy with that. It did take, it was a 2 to 3 year campaign that I was holding gold and silver. This year has been like a blockbuster year for gold and silver. And now it's starting to attract some mania. It's now starting to attract, like, the retail crowd is like everything gold, everything silver. And I get it. Like we could have a weird bubble, but it's like, I'm telling you, like, there's going to be some bag holders in gold and silver because there's going to be some volatility. Silver ripped again. We're over 100% year-to-date gains on silver. Everyone that wants to jump into silver, sure, we could pump up another 20, 30, 40, 50%. But that's going to come with look, if silver does this, where we had this crazy run for 100% and we're still going higher, okay, people end up buying it here, and then we go up and it's a low down here, a high up here, and the market still finds a 50% correction. And everyone that's buying up here is going to be in so much pain that I'm just going to wait for corrections. And I'll just scoop up some silver. I'll figure out where the bottom's going to be, and I'll just hold it as an investor. We get back to highs or higher, and we make money. But I'm not going to be a bag holder at the tops. So there's puts, there's dollar cost average positions. I'm waiting. But there are two levels, two assets I'd like to be a part of. Bitcoin, part of me, I'm being a little cynical here, but I think that there is an interesting kind of phenomenon that happens with debt structure, that if the pain trade is to drive MicroStrategy into like negative net asset value, that it could drag on Bitcoin. Because if Michael Saylor and MicroStrategy is forced to sell Bitcoin in order to cover their debt restructuring, because they have like 21 months to basically, with the cash reserves they have like a 21 month window to see if Bitcoin can stabilize and they can trade slightly below I think it's called the MNAV, which is the multiple of the net asset value for Bitcoin. And MicroStrategy is trying to trade slightly below that, so that way they never have to sell their Bitcoin. But when they trade above it, they tend to, if they run out of cash after 21 months or so, that they will probably have to sell some Bitcoin, and that would equal volatility for MicroStrategy and volatility for Bitcoin. But anyway, what else? Naturally, I think that having some, SPY and I hate to say this, but like, I'm not that excited about the NASDAQ next year. I know the tech might be great. Maybe the Nasdaq benefits from these, new AI companies that are coming in to do some disruption. So I could put the QQQ in there. It's a good index to own. But I think that Russell is going to be an interesting play, or like S&P mid caps, or even RSP is equal weight. So that's kind of my mix. And I'll sprinkle in a bunch of, bonus trades and probability trades and stuff. But like core strategy wise, I kind of like this mix. A couple stocks, gold, silver, index, and some Bitcoin, and I'll figure out what kind of pie chart I want. That's kind of my blanket strategy is going to be a pie chart allocation. And then I will still have cash reserves, and I'll still have ways to, play what I want to play. And that will be, if I can participate in an extra 5%, 10% gains in some probabilities elsewhere that's not related to this. Maybe it's best to be non-correlated, right? Maybe it's best to have some VIX exposure and be long volatility for the year, and just have some allocation where, there's asymmetry. If you're long VIX at 15, 16, and we have a flush up to 40, 50, 60 again, it's a great trade. You just don't know if you're going to get that position, right? So VIX is hard. VIX is hard to trade, but it is worth it when all it is, you could have like 2 to 3 times upside. You don't get a lot of those setups, kind of guaranteed every year. If we have a spike in volatility, the VIX is generally paying pretty well. Okay. All right. End of year blow up party, greater than 7,000, less than 7,000. Okay. Oh, there you go, Marco. 6-7. Oh man. It's funny. Like, I know it's really popular. I watched the South Park episode on how much they make a big deal out of it. I've asked, I teach golf to a lot of high school kids, and I've just asked everyone, and like, they don't know what it means. It's just become so popular. So I think it's driving the parents of boomers crazy, where it's like, what does this even mean? Even my buddy that's a middle school teacher couldn't even tell me what it means. So anyway, all right, what else? Mag 7 lagging. So I actually mentioned this yesterday. I did, this was my YouTube session in the afternoon, the lag 7, because of that. We have only 2 that's outperforming, and then we have the other 5 that are underneath. Does that mean we're going to see, asset allocation going into those mag 7s again? I don't know. Take a look at mags. This does have the writing on the wall of like, if this is a topping pattern, well, there's your topping pattern. We come up for a lower high. We work our way down into this area. I would measure this move 2 ways. Measure it as symmetry, and measure if it is a head and shoulders, measure it there. Okay. So take this box, go from high to low. And if this is a top that we hit, and I don't know this yet, obviously the market can push up and hit all-time highs by the end of the year. We could have a bump into the mag 7 by the end of the year. But if this is the top, there's a symmetry move. Okay. And then the break of that neckline would be down here. And that would be my measured move. So mags drops to, let's say, 61, or drops to 55. Once this is over, okay, you have to look left on the chart and think, is this a good spot to buy mag 7? Do I think these companies are going out of business? No. Do I think there's going to be way more pain ahead? I don't know, right? But if we have a low and we have a high, and we put in some type of ABC correction, whatever that looks like, and it could be more than just a 3-wave move. It could be this to this to this, right? Wait for a trend line break. But if we're at this previous all-time high, this technical area, it's probably not a bad spot to at least start participating if you want. Or does it come back to a 50% fib? Okay, let me drag this fib up here. Let's go to the highs, right? Drag that fib, and now we have a 38% right in here, and we have a 50% just a little bit lower. So if I'm looking technically, this asset mags, I'd say between about $55 and $50 would be a good spot. So between $55 and $50, not a bad spot to say, well, if it comes there, I will buy some more if you like this. Or obviously you look individually and you trade all your mag 7 stocks. All right, here's another question for the audience. What's up, Nick? How are you, man?
What's up? How's it going?
I'm just blabbering here.
Keep going.
I was going to ask a question. Do we think that in 2026 we have a new name? Instead of mag 7, it's going to be something else. Is it a changing of the guard? We have a new acronym. We have a new 5. We have a new 10. We have something else. I think there's going to be some interesting disruption where, if MicroStrategy does end up falling lower, we might see MicroStrategy removed from the S&P. and the NASDAQ. So there could be some interesting shakeups. I know that like Carvana's being added in. Anyway, I'm just curious, like if Mag 7 is like, okay, it's had its time. It went from Fang to Fang Man to Mag 7 to now what? Something. I'm just curious. Something new.
That is a good question. You're like writing poly market bets for them at this point.
That's right.
They're like, are they going to call it something different? Yeah, I don't know. It's
what are the odds on that? There's got to be a prediction marker for that, right?
I bet you there is somewhere out there.
If it's 5-1, I might consider it.
It seems like you've had a change in stuff even just this year. You were pointing out that chart about the underperformance, like relative underperformance of some of the names.
Yep.
Really interesting. I mean, it's just goes to show this market is K-shaped in many ways. It's like most stocks are not doing that great. You really have well, I mean, you have stock participation a little bit better here recently. I mean, RSP is doing okay. But it's just not the same as, you know, the tech stuff that's just absolutely flown this year, especially like semiconductors. I was looking at something interesting too. I mean, look at semiconductors, absolute monster year, gangbuster year for the VanEck semiconductor ETF. And then also, where was I going to go with that? You've also had like the consumer. This is like such an interesting opposite extreme. XLY has really not been all that impressive. In fact, 1 year ago today, you're sitting about the same, you know, level that we were. So we had this huge drop in the consumer discretionary ETF, consumer staple ETF is lower than where it was, you know, when we did this. And just for time's sake, from memory, actually this year or 1 year ago is when we saw a very surprisingly hawkish Powell. So we'll see if there's some resemblance of that. But just to show a chart, let me go back in time. That's right here where we were on stream together. And it was
one day off script Powell. I was like, this is not what he normally says.
Yeah, and we were expecting nothing out of it. It was like, oh yeah, they're gonna, you know, signal this, and then like complete just anarchy. The NASDAQ was down 4% on the day. I remember that being a pretty vicious day. So we'll see if there's any surprises. What is I'm curious, Chris, you probably already went over it, but just to catch up some of the newer viewers and myself, what's your outlook for today? You think the Fed's gonna, I mean, obviously they're pretty expected to cut interest rates. There's this interesting dynamic where you have the next Fed chair. I've been hearing like people saying like, oh, it doesn't even matter what he says because he's out in May, but it does matter because it does matter the consensus of the committee and you know, just the academics of the Fed and the policy rate and where they're headed with stuff. I'll just share my 2 cents on it. I think that they're going to cut rates. I think the bond market is sort of signaling that they're going to cut rates and then be sort of hawkish about it, sort of signal like no more cuts for a little while or pause, that they feel like employment's okay, which has been somewhat supported by some recent data. Let me just pull this up just to illustrate my point. ADP was bad. ADP was a big miss. But the NFP data, although it is delayed, was better than expected. The job openings were pretty decent compared to expectations. We had a really higher than anticipated jobless claims. Lower than anticipated jobless claims. That was also good. So I think what they're going to say, or Powell is going to likely issue, is okay, we're going to cut rates, and then we're going to sort of hold them there. At least for now. Like there's not like an urgency they're going to take it meeting by meeting. We know they say that every single time, but yeah, that's my thesis. Is I think it's going to be a bit of a hawkish cut, though. I sort of lean in the idea of thinking that they should continue to cut interest rates, but I just don't think that's what they're actually going to do.
Well, I think that right now, I mean, we had core PC that came out, and I think I pulled this chart up earlier this morning. So I think everything we're seeing in the yield market right now and the bond market is pretty much right in line with what the probabilities show that they cut today, and they don't really do anything until June, July. Now, at that time, Powell's going to be gone. I think if anything with Powell today, you know, I do think that he is more of a team player. He wants consensus from the Fed. I think the biggest concern I have in 2026 is you're going to have, you know, let's say it's Hassett that's Fed chair. But if there's no consensus and every month, every FOMC is like dissent, there's all this, you know, bickering going on in the Fed. It's like, I just think the Fed is going to like look pretty rough and have like little to no credibility. And it's going to be masked over by, fiscal policy anyway. But you don't want to see like the backstopping mechanism that has been so important to providing liquidity and stability in the markets all of a sudden having a fight at the dinner table. So I think that I'm hoping that Powell kind of brings it all together, and like data as far as inflation data, it's improving. I think the concern is that we have global PMIs. I think we're going to have stickier inflation, not necessarily like higher inflation, but stickier inflation. Yields, like I mentioned earlier, like they do tell an interesting story, which is like, Nick, we've cut after today, we'll cut 1.75% from the Fed funds rate, and yields are literally 50 basis points higher than where we started this in September 2024.
I saw you talking about that.
It's just a big red flag where it's like, okay, so we keep cutting rates, but nothing is changing. Buying a car, buying a house, refinancing anything is still more expensive than it's been in the last 5 years, and it's going to make it very difficult for businesses and consumers to extend that cash runway. So for today, it's like, I don't know what the Fed can do that really matters outside of just don't take away the punch bowl. Like, don't disrupt the market. Don't say something silly. I mean, the Fed really doesn't want to give the market any indication that there's struggling liquidity in the markets. I mean, credit spreads have widened a little bit, but we're still, pretty tight to all-time lows. But it's like I just feel like all it takes, dude, is one ugly thing to just house of cards, and we'll be down, 10, 15, 20%. And it's going to be another thing. You got to like backstop the crisis, but it's going to do a lot of pain. And so I think that at this point of year, it's like, don't do it. Like, just let the market limp in, maybe be at highs or close to highs. Just don't do anything to disrupt it.
You were talking about something earlier that I thought was a really good point, which is forward-looking returns. We've talked about this a lot.
Yeah, that's what scares me the most.
Yeah, when you have a really expensive market, the forward returns, and I love this way of explaining this. It's not my study; it's what I've heard other people smarter than myself explain it as. Is basically, valuation in the stock market being high is not necessarily a timing indicator that like, okay, I need to go out and sell every stock under the sun because valuation is high. But it does give you a temperature read of the room. And if the room is hot, meaning, valuations are high, everybody's hyped up, everybody is pretty excited about stocks and earnings. And what that does is it sets expectations high. And from a really simple standpoint, those longer term studies where high valuations have led to 10-year periods of underperformance. I was thinking about that when you were saying that earlier, and it made me think about something. How many of those studies where high valuations led to poor 10-year performance, how many of those, let's say that this is the stock market, how many of those sort of melted up in the high valuation period and then had somewhere along the way a significant reset event? Right. So my reason with saying that is that if we have high valuations and we're thinking, okay, 10 years from now, we'll look back and say, maybe the S&P 500 returns just weren't very impressive compared to history. By the way, last 5 years, they've been running at 15%, which is significantly
almost double the average.
Yeah, that's double. Yeah. There's a very hot period we've had recently that's led to these high valuations. Where I'm going with this is that my question then becomes, okay, if we're at an expensive level, could we see a melt up-esque event prior to a larger reset? I think it's there's the recipe is there for that melt up event. I'm not necessarily saying, I'm calling a melt up that we're going to go melting up and we're just going to go straight up into 2026. I'm not necessarily saying that. What I am saying though, is that we are at high valuation levels. What usually takes that out of the picture is not, oh, we're too expensive, now we're going to sell off. It's we're very expensive. And then something, as you talked about just a second ago, something bumps into the market that really wobbles it and really resets that valuation. So my thought process would be barring that we don't have some sort of Taiwan, China event, or the US 10-year yield screaming higher, or an oil crisis, something external that breaks the valuation. We no longer can justify this. Right now, everything else the same, I think you can kind of justify. We have a Fed that wants to cut rates. We have a president who lives and dies by the stock market that will do anything to keep it elevated. You have corporate earnings that look really good. You have AI hype. The valuation is high. I would argue there's a good reason for that. However, if something comes along to knock it off balance, we have to really seriously reconsider that.
Yeah, no, I agree. And to your point of a melt up, it's like based on how sentiment has been this entire year and being so negative, I could see the likelihood of a melt up first. And if let's say that what would be crazy, Nick, is like from here over the next 5 or 10 years, we actually saw like another 100% upside in the S&P and the NASDAQ. Like they literally double over the next decade. But yet there's a massive like 50% correction that comes with it. And it just shows like, well, it averaged about 2% a year for those 10 years.
I got to say, Chris, I don't want to cut you off, but just to say this, if that happens, if you get 100% melt up, I'll do something that I very, very rarely would ever do, which is I would take a contrarian bearish perception on the market. So I'm a trend follower. You know this well. The audience knows as well. I follow the trend. If it's moving up, I'm generally bullish. But if you had that kind of move, like some sort of irrational, euphoric, monumental rocket ship up move, I got to take profits off the table because history has shown that's a dangerous area.
Yep. Yeah. And, and again, take profits off the table. You don't necessarily have to position bearish. I mean, I just did the last few weekends, I've been working on, just a full strategy. That's like, if I just traded every week based on one simple spread every single week, and I only did it in the environment of we're bullish by my metrics and I participate in the market. When we're indecisive or bearish, I stay out. Now I tested it where I traded both ways, where I was buying in a bull market and I was bullish in a bull market and bearish in a bear market. And as you know, bear markets can be so slippery and so fast and so difficult to time and predict that even when we get all the alignments of a confirmed bear market, the price action week to week is so noisy that it still didn't do that well. It was like, it won like maybe 55, 60% of the time in a or a bear market, but it also I stacked up more losers that way because I was, I was looking at bearish spreads and the market would rip up on, I'll use an example like this year, like April 9th, the infamous day of it's a good time to buy, Truth Social, tweet, whatever. And the market went, I was looking at weekly ATRs and the market was supposed to move about 150 to 170 points that week and moved up 600 points. And I was in your office that week. That week was insane.
I remember that.
Outliers like that can happen.
But in 2022, we've talked about this so many times, Chris, but for the audience, if we could just show my screen really quick. So 2022 was such a bizarre, well, not even a bizarre. This is a good example of what shorting looks like and why it is so dang hard from a swing trading perspective, and why I'll be frank, I never short the stock market. I very, very rarely, and if so, with really small size, because it totally contradicts my style of how I trail stops. So if I'm using a trailing stop method, historically, I've done a lot of back testing on this. It gets ripped apart in bear markets, trailing stops, because, and again, maybe something will change, but in an up market, I can get in and then there's this sort of regimented higher lows, higher highs that work very well for my style of trailing stops. I've done quite well with that style in up markets. But when you flip to bear markets, I mean, I've shown it many times on my channel. I was down 30+%, 32% or something in 2022, just getting ripped to shreds trying to short, or not even necessarily just a short, but even longs, I would get faked out. But the point is, to your point, Chris, you have these sharp moves lower, very hard to get involved unless you're just straight chasing it, and then the just outright aggressive up moves. And then we repeat, and it's different. Look how sharp. Look at the wave cycles. They're huge in both directions.
Yeah, that type of behavior, and then go if you go left on your chart and just show the steady drift up. What market would you rather be in? Subtle, every
one is
week,
easy,
every month, all
really
time,
hard.
new highs, new highs, new highs, or rip your face off 10, 15, 20% swings both directions. It's hard, and volatility will ruin almost every strategy. If you're trying to do something technical, something strategic, something mechanical, systematic, volatility blows up everything. The only thing that I can benefit from in a high volatility environment is going way the fudge out of the money and selling some premium. And then I have to tell myself, well, like I did for these recent alerts, like SPYs and Qs, I was out 55% lower than current prices. And I'm willing to say, yeah, I'll own some SPY at a 55% discount. So it's going to pay me, a couple $1,000 when it's settled. Or if I own the SPY, I'm going to own it at a 50+% discount, which
Yeah.
I'll happily start there. If I'm going to start, establishing a position again, it's 50% lower than current prices. I think I can make some money there.
Yeah, makes sense.
Yep.
Chris, we've got about 15 minutes here before we are going to get the Fed cut.
Yep.
Or hold. I mean, it would be a big surprise, but very likely we're going to get the cut
Yep.
From the Fed. The market seems to, for audience members, we were talking about this earlier, but just to catch up to speed, we were talking about this earlier. The bond market through the U.S. 10-year yield seems to be feeling or sensing out or sussing out the idea that Fed is going to cut rates and then sort of signal a wait and see approach,
right,
with the idea of some better than anticipated jobs data recently, and the idea that inflation is still not gone away. So that seems to be consensus. What would surprise the market, and I'll say with this, surprise as in if you get a dovish cut, meaning if you get Powell come in and he says, essentially, we think we can afford to continue to cut rates. If we see in the dot plot a projection for more rate cuts next year than previously thought, that would surprise the market. And what that would probably lead to is a higher price movement in the NASDAQ, S&P 500, Dow Jones, especially the Russell, very sensitive to borrowing costs, and of course, weakness in the dollar. So that's just a bit of the gameplay here today. The risk, I would say, in terms of a surprise factor would be if you were long the dollar or short gold, silver, short stocks, etc., and you had a dovish cut. That to me would be probably where you could get the bigger moves today.
Yeah. Again, it'd have to be a surprise. I mean, I think the biggest surprise was going from a 75% pause to now an 89% cut. That's the biggest surprise. And we've already unraveled that in the last 3 weeks. So I truly think that this is a bit more of a nothing burger Fed, but we do have news next week. We do have CPI comes out next week. We have Bank of Japan rate decision, which I haven't seen consensus for it, Nick, but I think they might. If they don't do it next week, I think the BOJ is at least looking to raise another 25 or 50 basis points into 2026, which does threaten that potential carry trade a little bit. Japanese 10 years have rallied to almost 2% after some, currency exchanges and things it's not nothing. Like, it's still a positive swap, but it's definitely different than 0%. 0% to a 4% risk-free is a lot different than 2% to a 4% risk-free. We'll see. So
I've got a chart to show you on that,
ahead.
Chris, just with the Bank of Japan interest rate projections here, as you mentioned, out to 2026. They are expected to continue to to look to hike rates. So yeah.
So do you think they actually raised? Do you think they're looking to raise like 25 bips next week? It's just not on the calendar. That's what I was asking.
Yeah, I don't know. I haven't looked at it close enough to really make a strong call. You have in terms of, let's just take a quick look here. Inflation's at 3%. That's their worry, right? They're like, they don't like higher inflation there. I mean, they don't like it anywhere, but Bank of Japan is especially like not okay with that. Though GDP growth did come in pretty low, minus 0.6% GDP growth quarter over quarter. That's pretty interesting. So we'll keep an eye on that. But yeah, I'd be kind of mixed. I'm not exactly sure. I don't have a strong enough bias.
If it was a BOJ like tonight, like a Wednesday, Thursday, where it's right after the Fed, it's a piggyback off the Fed, I would be a little bit more concerned that it's like, oh boy, look for something kind of wild and crazy on the Japanese yen. Since it's next week, it's the last full week of trading. I don't know. It's still like this weird outlier where I'm like, I don't know how I can tell people more. Like, I just don't trust the Japanese yen unless you trade what you see and you trade pure confirmation all the time and you manage stop losses and you try to get to break evens. That's the only way I can see you routinely trading the Japanese yen with some consistency and success. Because if you're trying to call tops and call bottoms and trade fundamentally, it's like, I don't know, man. It's a crazy currency pair. It doesn't behave like anything else.
They may choose to change their decision, Chris, based on what happens here. With
possibly
the way to
the Fed chair too.
Yeah, the Bank of Japan has mentioned several times, they've reiterated that they want to be conscious of what's happening in other places with rates so that they don't disrupt the system, which is a hard thing to avoid if they were to hike interest rates quickly. That would, I think, if you had a Bank of Japan kind of off the rails, it would really seriously, cause some trouble.
Yeah.
But
and
yeah,
I feel like do you think that they were kind of reprimanded in 2024? Like that whole thread in July of 2024 was all Bank of Japan carry trade. It's like globally, it's like, hey, like keep that shit tighter. Like we can't afford. I mean, again, man, like that was a flash of systemic risk. What we did for trade war and liberation day this year was a flash of systemic risk. It's like these kind of like fires, they have to get put out, and we have the tools and levers to put them out quickly. But a good analogy of kind of where we're at right now with these valuations is we have, like, if we had a pot of water, we have been adding, like, we're turning the gas up higher and higher and higher on the range in order to like bubble and boil this like market. And so we have, like, instead of just liquid, like now we have steam and rising, and we've added all these extra like elements to it and chemical forces that are like, we have a different market. It's very manipulated. But when you look at the systemic risk that everything truly has, it's like nobody can really afford to watch the market crash. I don't think the US can afford to have a recession, Nick. I don't think the US can afford to have the markets go down, 20+% and stay there. I think if they go down 10, 15, 20%, crazy black swan exogenous event that all of a sudden we backstop and we fix it. But yeah, the concern is if we're down 50, 60%, we've got way bigger problems than, oh boy, the market's down. It's like, I don't know. I think we go into like deep recession if that's the case. So, Trump's scorecard is 401ks, and he'll like to brag about that a lot. We have a midterm year, so it's going to be all about pumping up the voter base to make sure that he stays in power and the Republicans keep the majority. All these things are like, these are tailwinds in my opinion. The headwinds are just the uncertainty around high valuations. And as long as earnings are solid, I think we maintain the path of least resistance. But it's that, like you said, that earnings compression, or like that one thing that kind of knocks the earning rhythm and knocks the earnings expectations off. And all of a sudden we see like really fast adjustments into, earnings expectations. And that will be a correction and a rotation out of Mag 7 too. I don't know how nasty that gets. Like, does everyone want out of Mag 7? I mean, they're the most profitable companies in the world. Why would you not want to have some exposure to Mag 7? It's just, I think this year everyone was underweight, and they just didn't realize like how aggressive the market would respond back in April.
Yeah. And Chris, if I could just show my screen here for just a second, check this out, guys. Just kind of a rapid fire here in terms of some key levels that I've got marked up. I'm sure Chris has gone through some with like on the S&P 500. I'm just going to rapid fire some charts really quick as we've got 7 minutes to go. So here's where I'm thinking you have euro dollar sitting at a pretty major level of resistance. I'm curious to see if you were to get the dovish cut, which is not super likely, but possible. If you get something from the Fed that sort of signals worries about the jobs market, willingness to continue cutting interest rates in 2026, maybe sooner rather than later, that could get us above. So watch for that dovish cut to get us above euro dollar. And if you get something that is more cautious in terms of, hey, inflation's still a problem, the jobs market seems to be holding up okay. If you get, it's all about the jobs market perception. Do they see the jobs market as okay, or do they see the jobs market as really in trouble? If they see it as okay, dollar could strengthen, and we could potentially see the euro dollar maybe make a push in coming weeks back down here. Of course, depends on that CPI report that we're going to get next week. But you're at a critical level of resistance. If you start sniffing out the dovish cut, we could see a little bit of momentum here pick up in the euro dollar. Same thing with the pound dollar. We've been on a little bit of a rebound here. Take a look at the dollar yen. We were talking about yen just a second ago. Dollar yen's been on a tear here to the upside. Watch for that surprise hawkishness. If you were to get that, dollar yen looks like an interesting one above that 157, 158 area. Could be an interesting spot to watch. Shifting over to the precious metals here, I've got a long trade on gold here. Stops are below this structure. It's just been the most boring thing to watch gold here recently. But let's see if we can get some decision one way or the other. If we break down, I'm going to take profits on this for a small win. And if we can get back above, if you start to see, worries about the jobs market, we're going to keep cutting interest rates. There goes gold, I think, to the upside. If you can get that narrative, that's where I kind of lean towards they're going to pay attention to the jobs market. Maybe Fed Chair Powell is going to get in front of the next Fed chair by saying kind of, we're already going to take the dovish stance so that he takes away that call from the next one. I think, honestly, if I was Powell, that's what I would do. I said, okay, look, the next guy's going to cut rates. I'm going to do it in my way so that we can start this underway. That's how I would do it if I was Powell. but we'll see. I'm not Powell. I'm Trader Nick, the YouTube guy. So we'll see what he says. And next one is S&P 500. You're 1% away, or just a little bit more than 1% away. Yeah, 1.25, 1.3% from all-time highs. Market would cheer, I think, if you were to get that dovish cut. If you were surprised that Powell's really on our side now, we don't have to wait for the next Fed chair. Up and above this 69.20 level, if you were to see that break, I think that leads you to 7,000. But it would depend, because you get a little wobbly up here, right? Can you actually get above there and stay above there, or do you get some sort of false breakout? We've seen all sorts of crazy candlesticks on Fed day, so be careful with that. But again, I remain kind of cautiously bullish on indices. My positioning is long the Nasdaq. I also like what you were saying earlier, Chris, about Russell next year. Chris, I'm gonna point myself out here. This is the third year in a row. Come on, man. Russell, outperformance this year. I've been wrong twice in a row. Don't do me a third time wrong, Russell. I think Russell has some upside if they cut rates. So a couple levels for you guys in the chat. I'm trailed stops on NASDAQ. But maybe we'll see it, Chris. Maybe we'll see a little bit of rotation next year. I think it would be healthy.
Yeah, I mean, rate cuts are going to be key. I just don't know if just the blanket rate cut is enough to truly change the borrowing structure of what a small cap company needs.
Mm-hmm.
It's like, I mean, so yields have a lot to do with that. But from the valuation standpoint, I was a little surprised to see that the earnings expectations for next year is like the S&P at like it was like a 13 to 15% earnings improvement, and I think the Russell was slotted for like a 59% earnings improvement, which I don't know if I've ever seen the Russell with expectations like 5 times more than the S&P. But we'll see. Obviously, that's setting up for disappointment. However, from the current trade, it's like we did just hit all-time highs on the Russell again. One thing that gets pretty tricky here near these highs is, let's say that we do go a little bit higher. I mean, we talked about this many times this year, Nick. After having such massive direction down and massive direction up, indecision can certainly be an environment that we have to navigate. So, up can happen, but if it's a fake out trade, I don't think, necessarily it's going to reverse and go down. It's like a broadening pattern or something choppy, something range bound is real. Like, you have to recognize, like, the markets don't want to crash. The markets don't want to just rip parabolically. It's like they're just trying to figure out like how they can grind. Like, grind higher is good. Too aggressive on one side, too aggressive on the other side, it requires like reflexiveness, and the markets just don't do that type of stuff, or they do it and all of a sudden we have more volatility, because what goes straight up typically comes straight down. What goes straight down typically reflexively comes back up. But a grind is like, okay, at these valuations, hard to keep outperforming. I could see the grind being like more of a sideways change. So
Chris, here's a question for you. Speaking of a grind, the crypto grind, what's happening with Bitcoin? Do you think there's any? I've been watching it because I think you've got this downward structure here that wants to try and break out here. I'm not trusting it. I haven't touched any trades on it. I know you and I talked about this a couple weeks ago. I've been waiting for some sign of life, some higher. I mean, we're trying here to put in some higher lows. Is there anything here? Does crypto have some room to rebound, and or do you stay far away from it, given being a little cautious on valuations anyways?
There's two approaches to me on crypto. One is the bottom's not in and we have a diversion flush. So if let's say that we have, because we've gone high to low, pull back, we break the lows, high to low, pull back, we break the lows, high to low, we pull back. If we break the lows again, that's obviously going to be like a big lump of coal in everyone's stocking this year. But if we break the lows and we do it with divergence, I could see that being the bottom that you're looking for. Like, that's volatile, but I could see that's how the market kind of finds itself a bottom. Otherwise, like you said, if we just kind of grind higher, any type of close above 100K is encouraging. A close back above 107 to 108 is where I'd like to see the bulls kind of regain structure. So I'm in. Like, all I did is, as this was dumping, I just sold at the monies, and I just accepted the fact that, okay, I can get 22 to 25% return on a covered call. And if I want to buy some more Bitcoin, I'll do it here. And I've got some breathing room, and also I have some upside if I add new positions. So I just decided to lower my cost basis pretty aggressively going out 6 months or 12 months. And I want to see if we can kind of bottom out. My concern with the Bitcoin stuff is that I think MicroStrategy is going to fucking ruin Bitcoin for a moment. Like, it might be a short-term thing, but like the pain that it's almost like the market wants to teach Michael Saylor a lesson. But, we also have Trump and his family, and we got a pro, Coinbase. Is it Fed shares? Like Hassett, a Fed, he's like a Coinbase, like $1 million stakeholder in Coinbase or something ridiculous like that. So BlackRock's in the ring and Fidelity's in the ring. And it's like, there's a lot of big players in the arena that, speaking of, we got some volatility going on right now. Do you want to bring the screen up with your kind of 8 charts up to see what's moving and shaking?
Yeah,
We just saw a big spike up in SPX.
Yeah, so Fed did cut interest rates in line with expectations, 3.75%, lowering borrow rates. Let's just take a quick gander here. We'll come back to what you're saying in just a sec, Chris.
Yep.
Chopping around here, S&P 500, little bit of movement, but not too much there. Dow Jones, surprisingly, kind of outperforming today. Actually, it's been a couple of days where Dow's been okay. Bitcoin, little bit of a pop. Dollar index, initial move lower. Gold is initially making a little bit of a move higher on the 1-hour chart here, 4206. Silver, a little bit of life. Oil prices pretty unchanged. We'll keep an eye on it. But as we always say, typically it is the press conference, right? The market is smart, right? The market already figured out we're going to cut rates like 2 weeks ago. And so we cut the rates. The bigger question becomes when Powell takes a stand, is he going to signal we think the jobs market needs more cuts, or is he going to say we think the jobs market's okay, we can hold them? I lean towards the idea that I think that they're going to cut rates, and that is not within consensus. It seems like the bond market has disagreed with me recently, and maybe the bond market's right. Usually it is. So we'll see if they got me on this one. But keep going, Chris. What were you saying?
Well, no, I just mentioned, like, if all the financial engineering that's happening with MicroStrategy, if that ends up being a reason for Bitcoin to just get dumped because of the holdings with MicroStrategy, and granted, like, MicroStrategy is essentially treated like a 2 to 3 times leveraged Bitcoin, but it is a way to kind of push the leverage out of Bitcoin. And I'm hoping that a 30+% correction has already done that. I'm hoping that a 70% correction in MicroStrategy has already done that. So we'll see, but I do have like long-term goals, but I think this year, and again, I've just made a decision where it's like, I think Bitcoin for me has to go back to being a trade and trade it and take it like a trade, as opposed to I'm just going to keep a 5 or 10% allocation and just roll with it and ride it. Because now that it's kind of mainstream and now that it's financialized, I think it's going to be difficult for Bitcoin to have like 100+% upside without having 50, 60, 70% downside. So now that we've had, this would be our second flush of over 30%. But if we have upsides of 30, 40, 50%, we just kind of, let's say we've cut the volatility in half as an example. So anyway, I'd love to see a bottom, like you're talking about the charts on Bitcoin. I just think that the price action, because it's just such a sharp low that was created, I could see it coming back to retest, failing, and then going up. I could see it flushing lower, bottoming, and then going up. If it just kind of slowly grinds higher, awesome. Because, Nick, gold's up 50, 60% for the year. Silver's up 100% for the year. Bitcoin is down for the year, or flat, I guess, for the year. I'm not sure where we started exactly, but let's look at the candle. What is Bitcoin year to date? Is it still green or is it red?
It's
red.
negative.
Yeah, it's negative, barely, but
yeah.
Check
this out, Chris. I got a couple of headlines for us.
Yeah, let's go.
Some interesting stuff here. All right, so here we go. They cut the rates as expected. Fed median projection maintains 25 basis points of cuts in 2026. That's the dot plot stuff. The Fed says we will consider the extent and timing of additional adjustments. They also say we will buy $40 billion worth of Treasury bills over the next 30 days. And as Marco in the chat put together, thank you for putting this out. Fed, we had Schmid and Goolsbee dissented in favor of no rate change. Now, why that's interesting, as Marco pointed out, is just 2 dissented. So it seemed like consensus actually swung heavier in favor of a rate cut on today's move. So it was sort of like it's a vote, right? So if most of them are like, oh yeah, cut the rates, that shows a little bit of the mindset of the Fed, which seems a little bit easier of a call here today to cut interest rates than may have been previously expected. Fed will begin Treasury bill purchases on December 12th. And the median unemployment projection, 4.5% in 2025, 4.4% in 2026. Unemployment edged up through September. Four officials see at least 3/4 point cuts for 2026, and a vote in favor of policy decision was 9-3, with Fed's Mirren preferring a 0.5 percentage point cut, and Goolsbee and Schmid, I hope I'm saying that right, preferring no cut. So it actually seems like the decision to cut interest rates today was a little bit more decisive than perhaps the market had thought. And, again, my thought process with this, I said it earlier, I'll say it again. I think the Fed is going to start to recognize that there are lots of parts of the economy that are hurting, and they see it, right? We all know, we've said it a million times, K-shaped economy, housing, consumer spending, lower end consumers, people who don't have assets, people who don't have homes, people who want to buy homes, who can't buy homes. There's a clamor for reform in regards to lower interest rates because there's a huge swath of the economy that's not doing great. And then the wealthy asset owners, when we talked about this earlier, I listened to you rant about this too, Chris, and I've done it 100 times. It's a bifurcated market. You have, winning stocks and the rest of the stocks.
Right.
And that is showing up. So it's not, there's no hidden agenda here. People know, the Fed knows that not all parts of the economy are reflected in the S&P 500 at where it is.
Right.
I was looking at an interesting chart just to add something. This is the RSPD. A little interesting one to add to you guys is to your watch list. This is the equal weight S&P 500 consumer discretionary ETF. So this doesn't look like the same market that the S&P 500. This is equal weight consumer discretionary stocks, right? So these are people's discretionary spending reflected in a ETF across a bunch of stocks. There's also the RSP. What is it? It's the consumer staples. I'm looking for staples. There it is. RSPS. Add this one to your watch list. Here's consumer staples, right? That paints a different picture for how, consumer companies, people who are consumer facing, retail, right? You can look at retail stores. They've been not very particularly attractive. So just something to think about. The Fed sees it. The Fed knows they've got all the brainiacs watching this stuff and saying, yeah, housing's in the gutter. You've got things that are needing rate cuts. And that's my opinion. I think they're going to keep cutting rates.
Yeah. I mean, they've received nothing but terrible criticism on being too late and being too reactive. And so if this is a way to kind of step in front of that and kind of, I don't know, I guess pander to what is been the biggest criticism of them being just way too behind and way too reactive. Yeah, sure. I mean, also it gives Powell a good thing to leave on too. It's like, if the market finishes the year at all-time highs, I mean, you can look back and say he's had some policy mistakes, but I mean, dude, we've had some interesting underbrush that this market refuses to acknowledge. And it's like, we could have had way bigger problems, but since 2008, yeah, I mean, when you have a 20, 30 to 50% correction in the markets, people that have dry powder to buy those bottoms are going to make a crap ton of money.
Yep.
It's that simple. If you're a 401k investor and you stayed in the markets for the last 20 years, you've made money. And the sad part is I think that all this gets glossed over with the fact that everything in our life is more expensive. So even though my portfolio was up hundreds of percent, my life is probably 50 to 100% more expensive too within the last like 5 years, man. Like everything's more expensive.
And so it's like, if you don't imagine the lifestyle of people who do not have that portfolio,
I get it.
Yeah.
That's the saddest thing to think about is like, I mean, look, Robinhood brags about democratizing trading and stuff. And you've been doing this for a while. I've been doing this for a long time. The point is, like, I couldn't imagine not having something in the markets to just have money working for you, because if it was just all I did was work and all I did is collect a paycheck and just hope life gets better, it's like nothing is working for you. Everything that you do is you have the same salary, the same comp, and all of a sudden life as you know it is double the price. It's like that's unfair, but that's what people are dealing with. And honestly, it is like, I'm going to say in the US, it's probably worse in the US than elsewhere, because I mean, I've known people this entire year that have traveled abroad. They've gone to Japan, they've gone to Europe, they've gone to Australia, and they've come back saying like, it was actually like an awesome trip. The weather was great. Not that matters, but it's like, but everything was cheap. Everything, my dollar went further. It's like, right. But that's just, it's cheap. Like life doesn't have to get double the price like we have here. And one thing that's crazy that's happening now in front of our very eyes is so many things have gone from like mom and pop businesses to private equity. And I just saw this tweet, and again, Twitter, so I take it with a grain of salt, but it was like Cold Stone Creamery is now privately owned. And like the smallest Cold Stone, like gotta have it or whatever the hell they call their things, it was like $10 for like a scoop of ice cream. I mean, Starbucks, it's $6-7 for a freaking coffee. You know, it's like that's probably
there's
not
so
fun for anybody.
There's so many things. I mean, we could go down, Chris. We could you, me, a fireside chat in the audience. We could really talk about, like, for example, like alcohol has gotten more expensive. I think people are drinking less. I think that's part of the reason is people are having kids less, not just in the US, globally, right? You know, things are expensive everywhere. I mean, but yeah, I think part of the reason, to add to your point, in the US specifically, you know, we've had one of the best one of the, if not the best performing stock market over the last like 5 years. So it just feels even more divided because you have people who are in the US stock market because US people buy US stocks heavily. If you had them, you did great. If you did not have them, you didn't get that same effect. Anyways, just to bring it back here in terms of today's, you know, what's going on. S&P 500 is up 0.3% in response to this. Again, a more dovish than anticipated vote in terms of the decision to cut interest rates. And I'll go back to say something I said earlier, Chris. I think if I'm Powell right now and I know, hey, my replacement is all but picked and that dude is going to take my thunder in terms of cutting the interest rates, the stock market cheers it. I'm not going to let him take it. I'm going to take it, right? That's right. If I was Powell, that's what I'd do. So I think there is a potential that the standing Fed people are like, hey, our boss, the president, the unofficial, not really the president, but, you know, his approval is important to Fed members. Right. You know, we want that now. We don't want to wait for the Fed to get completely, you know, rolled over, reset, and you know, a criticism that I think is valid is that, you know, people are pointing out that the Fed next year is essentially getting completely owned by the presidency, which is a little bit weird. The independence of the Fed is, you know, supposed to be something there, but I mean, we're going to have truly some paradigm shifts next year with the Fed essentially becoming the controlled entity of the president. Pros and cons there, but the point is we're going to get some rate cuts next year. The bond market may disagree on the long end. The short end, of course, will love the idea of rate cuts. I'm talking credit card debt will be more accessible to people at lower borrowing rates. Auto loans potentially will be lower end. But the big one, mortgage rates, the housing problem, that is only going to be better if the bond market agrees with the decisions to cut rates. So the Fed, I don't think, just because you have a Fed switch and the president wants rate cuts, doesn't necessarily mean that mortgage rates are going to come crumbling lower. What would get mortgage rates to come crumbling lower would be if inflation cooled off or if you had some sort of massive recession. One of the two.
Yeah. We have pretty much a standstill in mortgages right now. I mean, the refi is minimal. Houses are sitting on the markets longer. Depends on what markets you're in. But, you know, I've got friends of mine that are in Florida. They've watched prices drop, you know, 6 figures. Like, list a house at $800K. They're now asking 700 or less. It's been on the market for 90 to 120 days. Inventory is sitting stale. You got new builds that are still trying to catch up. Look, man, a supply side catch up is great, but all that's going to do is hurt overall home prices, not necessarily rates. I think that's the deal, is you can't have both. You can't have home prices get cheaper while rates get cheaper. It's one or the other. And right now, the bond market's telling us that it's yields and borrowing costs that are going to stay sticky. And therefore, it's like prices have to adjust. And so people that think their home is worth 3 times what they paid for it are going to be mistaken when it sits on the market for 120 plus days and they realize I'm going to have to trim, you know, 50K off, 100K off. If I want to move this house, if I'm motivated to sell it, you're going to have to give people a discount. Well,
Chris, all you do is you just sign up for a 60-year mortgage. It's not that hard.
Oh yeah. I mean, hopefully everyone knows, like, if there are plenty of videos that dove right into that math. If you did a 50-year mortgage, that you would only have about 5 to 10% equity after half of that mortgage. Like, so you're paying like double or triple the overall interest, and you're building way less equity in the first like 10, 15, 20 years versus a 30-year. And look, and literally you're doing that to maybe save $100 to $200 a month. And that is called being penny wise and pound foolish. So please, like, number one, I think it's like they're throwing things out there, at least acknowledging, and I'll be glass half full. It's like, at least the administration is acknowledging that there is an affordability crisis. So We'll throw it out there. Does it stick? And then just people absolutely shred it. That's fine. But at least they're showing like, okay, let's think about this. Because, and the other thing that I don't love is we offer all these subsidies and we offer these tax credits. But what happens on the back end is, okay, every child gets $1,000 account. Cool. What's that going to do? I have no idea, but it's probably not going to be, it's going to be offset somewhere, Nick. If you give additional tax credits, what happens to healthcare costs or daycare costs for children? It goes up. So if you have a $5,000 tax credit, daycare just got more expensive by $5K. If you have a $6,000 auto credit, cars just got expensive by $6,000. Like, you literally don't gain anything from all these like bullshit programs that are put together to make it seem like you're trying to make things more affordable.
Yeah. Just a quick update here. Yeah, no, I'm with you on all that stuff. It's like playing Jenga. You push something out somewhere and it pops out the other side, and it's, man, they have a hard job, trying to pick the right things to do. Anyways, quick update on some of the levels we were just talking about. Russell is hitting, at the time of speaking, a new all-time trading high. Maybe I'll be right this year. 3rd year in a row. Is this the year that you want Russell to outperform this year? Like, what's our year to date right now? How close are we? 2026.
Okay.
2025 has been, lackluster. Actually, I don't know if it's outperformed or not, but I last year and the year before, I figured, hey, I think the Fed's going to cut interest rates. I think that should lead to the Russell doing some upside outperformance as long as we're cutting interest rates slow. Mm-hmm. I think we're cutting interest rates slow. So I think that there is still that potential for a strengthening to the Russell. So I'm watching for it. By the way, Robo Ola in the chat, thank you very much for the $11.99. That will go towards this coffee. This coffee used to cost, it cost me 30 cents. Now it cost me 11.99 euros. So thank you very much. I appreciate it. But yeah, Russell making a break here to the upside. You've got NASDAQ green on the day, S&P 500 green on the day. We'll see if it can hold those gains. Again, it matters what the press conference ultimately, how many times have we seen a move to the upside get erased or a move to the downside get erased? So
right.
I wouldn't draw any conclusions just yet. Dollar index, at least for now, is soft off of what was a dovish vote here. Fed committee members seem more poised towards cuts than prior expectations showed. 10-year yield is lower. 2-year yield is significantly lower here, at least for now, seeing a little bit of rejection off this. That euro dollar idea, watch for this break in closure above today. If you can get this kind of move, then we look strong. I think euro could have some upside. And in fact, Edgefinder has some strong readings right now for a lot of dollar crosses. Now, I mean, like dollar bearish ideas like Aussie dollar, Kiwi dollar, euro dollar, at least for now, has shown some relative outperformance of some macro data for these places. Not necessarily saying they're the better economies, but that recently their economies have shown some upside potential. Trend seems to be shifting to the upside for some counter dollar crosses. You also have on the downside here, not too many dollar crosses, so maybe not as much there. In terms of other ideas, Bitcoin is getting a bullish rating. We talked about that earlier. I have to be cautious, wait for some sort of higher low, higher high sequence there. But trends starting to try and form higher seasonally. It's a pretty decent time for crypto. NASDAQ also getting a strong reading overall, probably off of some of the recently better than expected job statistics, growth metrics, and crowd sentiment. So we'll keep an eye on that. You've had a market that hates this rally, and I think that is part of the reason it's kept going for so long. So we've talked about that many times. Although, Chris, it's changed a little bit recently. Sentiment.
It's a big shift last week, dude. Big shift last week, and that does make me a little bit more cautious into that kind of 7,000 high, where maybe that's enough that sentiment has. Like, the towel's been thrown in on the bearish side, and now we're just kind of joining in with the bull market at 7,000.
Yeah.
And again, I said this when it first came on. I could see the markets doing. That's why I asked: are we going to go be greater than 7,000, less than 6,550, or in the middle? I think we're going to be in the middle into these, next maybe 3 to 4 weeks. Typically, December is still bullish. We might just kind of eke out a little December gain. Maybe we test 7,000. Maybe we drift up into it, but I'd still expect a 10 to 20% correction in 2026. And maybe it's best, like it was this year, to get it out of the way early, and then you can just pump it up through midterms. Or maybe that was the whole point of this year's Liberation Day, was get it out of the way early. Trump can fix everything, and now we're just melting up until midterms, and we see where the voting sentiment falls in 2026. But yeah, it's I don't know. We've had a great year. It's just been such a weird year, carried by so few stocks, such high concentration. The rotation never really worked. If you had dry powder and the courage to buy during Liberation Day, you made a ton of money this year. It's that simple. It's like, if you did, congratulations. If you didn't, then you're underweight equities and you just been behind the 8 ball like all year trying to play catch up. And that is one thing that could drive us into all-time highs at the end of the year, is trying to get some ounce of like, what's the best way to perform into the end of the year, Nick? Dumping stocks or actually seeing it melt up into the end of the year?
I think it is the latter.
Yeah.
And to add something, I want to defend something I said earlier, this idea of the rotation trade. I've been early to the idea, but let me explain why I still think the idea itself is still valid for a potential rotation going into 2026. I have made the claim, the idea that I think that the Fed is going to acknowledge some hurting aspects of the economy, the jobs market showing signs of weakness. We're in a low hire, there's not been like mass layoffs, at least as of yet, but there has been very low hiring. There's a number of things to show. We can just take a look at, the revisions downward, those massive revisions that we saw in September, I believe, of this year, where you had, giant revisions lower in jobs data. There's no question, people will dispute whether or not how much you can trust these data points. Put it to the sidelines for a second. The trend is what matters. This thing is trending down. The jobs market is clearly showing signs of needing some assistance. And job openings, guys, have been for years in decline since the post-pandemic era. There's no question that the jobs market is saying, hey, Fed, look over here. We need some help. And so I think that's going to continue to support rate cuts. Now, when I say some of the same things I've been saying for some time, that rotation trade, the reason I defend that is because if they do cut interest rates, dividend stocks start to look a little bit more attractive. Because the yield that you could get in bonds, if that erodes away, the yield that you could get risk-free in the money market account, savings accounts, these places where you could just park and collect something, start to dry up, and people are going to have to get off the bench. And those same investors, they typically aren't the ones to go buy tech stocks. They're the types of investors who just want income. They want something safe. You were talking about some income ideas earlier, Chris. Where could they go? They could go into, if they're sophisticated, they could do some options plays and get into the Pulver alerts and start learning something over there.
Box spread.
Right? Or they could, if they're not so, willing to spend so much time on it, just look across the lexicon of dividend stocks that could start to become a little bit more attractive. They've been a landmine here in recent years. Dividends have been, quality stocks have underperformed over very long stretches of time. However, when you get a market that's not so hospitable, we talked about this earlier. Stock market's been an incredible environment in the last 5 years. We don't know if the next 5 years are going to be so safe and sound. And so if you get a tougher 5-year stretch, quality stocks could have their day in the sun. Just when people completely give up on that idea, that's where you could get some surprises. Also, one quick thank you. Forex James in the chat, 20 euros, A1.
That's the coffee fund, dude. That's the coffee futures fund.
Wow, beautiful. That is
well played.
Is a reading comment. Well done. Thank you very much. Appreciate you.
Very nice. Okay, man. Hey, we've got 60% of stocks advancing, 37 declining. Microsoft having a big red day. Palantir's up. Amazon's up. Tesla's up. Netflix down. Somebody asked about Netflix earlier. I think it was Melissa I saw in the chat asking about Netflix, or Sarah asked about Netflix. So Netflix did a split recently. I threw in a position on Netflix for the Pulver alerts. I went out a ways. My trade is out of the money, and it's down into the 70s. Let me see what I put here on Netflix. So I'm willing to own the shares. You've got the king of streaming. At some point, it's going to be like cable all over again. It's going to be Netflix, and it's going to be Netflix and HBO and Prime and this. It's like they'll all be the same freaking purchase. It's like, but right now it's all segregated and it's all separated, and then they're doing bundles, and it's super freaking annoying.
Who's going to get Warner Brothers?
Well, I think so Warner Brothers and Paramount are like going back and forth. I think they tried to like one up the Netflix bid. So like prices were up and they're falling again. So I'm not sure if that's getting taken out from underneath Netflix.
And Netflix is in free fall recently.
Yeah. So here's a trade that I have. I did. Let's see here. This is in Pulver alerts. Netflix was 78 by 70 out to 2027. So I'm going out just over a year. I pulled in $1.20. It's a pretty simple income trade. If I were to own, I'm just going to label this as a ratio spread, because that's what it is. If I were to own shares of Netflix, trading at 93.40 right now, my probability of profit remains about 80%. And the ownership price would be 70 minus 8 minus $1.20. I'd own shares at $60.80 on Netflix. So that's after the split. $60.80 is down here and off of recent all-time highs. That would be Netflix is now trading around a 55% discount.
Yep.
Would I be willing to own Netflix at 55% off? Yes. I came back to these recent all-time highs around 70. I don't think my trade is necessarily going to get assigned, so it should just be an income trade. But if it is assigned, we have past resistance to become support. We have a trend line here that when this is done with a correction phase, whatever this looks like, I think there's good opportunities to be long Netflix. But yeah, I like the trade. It's just the split was welcomed for cheaper prices because this was up to $1,000 stock, and I'm not going to trade a lot of expensive options around $1,000 stock. But now that it's 93, let's have its day. Let the Bears run with this a little bit. I think it's noise, but I still think it's a strong company, kind of king of streamers. They continue to add more subscribers, and soon they have like games on their platform now. They're going to have more. I'm sure they're going to add like a commercial tier again. You're going to have to pay more per household. It's the same crap we've been dealing with now for. Dude, Netflix has been around for 20 plus years, and I had a buddy.
The next thing they're going to introduce, Chris, is dish satellites that go on top of your roof.
It's actually they're gonna partner with Starlink, and there's going to be like that's like internet plus like every Starlink setup comes with Netflix streaming.
They're actually gonna wire DSL lines into your house so that you can watch TV on demand.
Oh baby.
Check this out. Another chart just to go with the Netflix idea. Stock selector here, Netflix, forward PE ratio. You're getting it even if you bought it right now. Now, this is going to sound out the gates controversial. The stock is cheap relative to its own history right now. It's not a cheap stock, but it's cheap relative to its 3-year average. So the forward PE ratio under 30 here. That's below the 3-year average of 36. The trailing 12-month PE ratio 40 versus a 44.3. If the revenue of the company stays relatively the same, if earnings stay the same, and you do get that stock sell-off, you could be looking, Chris, if you were to get assigned on that, at a really, really cheap valuation, especially versus history to the stock. So I like the idea. I think I've been watching Netflix myself. In terms of what you can see here, all these green segments just mean that the valuation currently is looking attractive relative to the stock's own 3-year average performance. So I like the idea. I think, if you were to see a little bit of a pullback in the market, I may join you on that idea of potentially longer term. I'm happy to hold. I think Netflix is, it's the king of the streamers. If I was to buy a streaming company, it would be Netflix. We'll see if we can get a little bit more of a haircut on the share price there. Taking a look, just checking back in on some prices. Guys, flat. 1 minute and a half. We're going to pull up the stream here. We'll watch what Powell has to say and see a reaction. I'll pull up our overall view. S&P 500, pretty flat, not too far in either direction. NASDAQ, same thing. Dow Jones, Russell, still flirting with the idea of trying to break out here. Dollar index a little soft. VIX is unchanged here, actually down a little bit today. Take a look at gold, soft, not really moving anywhere. Silver, just a little bit of a pullback from yesterday's move. Bitcoin, flat, but kind of testing this area. We'll see if we can get some sort of significant breakout here in the coming days on that one. Yields signaling pretty unchanged. Again, gearing up for the Fed press conference, which is ultimately what matters most. Forward-looking indication of what the Fed thinks. Euro, same thing. Tested that resistance. No significant follow-through just yet. But again, press conference will guide us a little bit more decisively, I think, one way or the other. See if we can follow through on that initial move, or if we're going to reverse it and start seeing the opposite, a little bit more hawkish outlook once we hear from Powell. We'll see. Again, I'm going to keep this open, and I'll pull up the thing on my side. Chris, while I do that, if you want to just keep going, I'll pull up the stream.
Yeah, sure. So I'm going to set a couple chart alarms on the VIX. We had a morning high around 17.66 VIX, which I did measure out some tops and bottoms on the day. So as long as that chart alarm isn't activated, we're going to see what happens price action wise. I also set a VIX alert right now just at 16 to see if this continues to go lower. So my thoughts on the day is if the VIX continues to go lower through Powell's press conference, that we might end up poking my measured move on the day. It's funny how this works, but I try to find highs and lows every single day in a 0 DT environment. And the VIX is a really great instrument to do that. So I have it measured out where roughly my high today is around 69.15 to 69.25. My low for the day, as long as the VIX does not exceed 17.66, our low for the day would be about 67.58 to 67.47. Obviously, if you're trying to call the top or the bottom, call the top that I calculated, call the bottom that I calculated. And honestly, at the end of the day, this probably just finishes somewhere in between. This is what typically happens during Fed days. It's a big Fed indecision candle, and what matters is post-Fed. Post-Fed, are we getting this price action Thursday, Friday next week, or are we getting this price action Thursday, Friday next week? Right? Like meaning tomorrow and Friday and all of next week with the final full week of trading for the year. Are we breaking higher than today's indecision candle? Because with Powell's press conference here in just a couple minutes, you can hear what he says. It doesn't really trigger anything in the markets outside of, oh my gosh, Nick, prices ripping higher, like falling lower. It doesn't really mean anything that he necessarily says. It's so hard to pick like a sentence, a phrase that triggers an exact market rip or a market sell-off. But if we're still indecisive, just look for the post-Fed movement. If we're getting a breakout one way or the other, then I guess Powell wants to make it a little bit more exciting here before the end of the year.
We've got it here, Chris. I'm going to mute us just because you'll hear yourself if you speak. So,
policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline.
sounds dovish so far.
The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a 1/4 percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard. Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend, so it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing, but that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the two official dissents against the cut, but there were also soft dissents from four others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our two goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks? And what does your forecast look like? And where do you, ultimately, where do you think the bigger risk is? And it's very unusual to have persistent tension between the two parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire. Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's getting a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things and we say that this was a decision to make. It obviously wasn't unanimous, but overall, that was the judgment that we made, and that.
All right, guys, I'm going to call it good there. We've got a trading battle here starting in just a second. Chris, overall, surprisingly dovish, at least from my take. Did you hear anything that sounded significantly more hawkish than expected?
No, he I think acknowledging the labor market as much as he did, I think that was the dovish tilt that the markets were looking for. I think that they got it. This is pretty good price action, kind of take us into the end of the year. Again, watch and make sure there's follow through here versus a big reversal. But I think that this is a good sign from the Fed, just kind of keep things going. They essentially also are talking about quantitative easing. They're not, or some type of balance sheet expansion. So they're back to expanding the balance sheet, and they just literally rolled it off. So it's very much to be accommodative, and the labor market was mentioned many times throughout every comment. So I think that was taken as pretty dovish.
Straight up dovish. I mean, and you could take it many ways, but what he just said about the jobs market at the end, he said, we actually think they're overstating the jobs market themselves. I mean, straight up, acknowledging like, hey, they might actually be down 20K per month. And we got to move on the jobs market. I mean, it was pretty dovish. Guys, we got to run. Chris has got a show, and I've got another trading battle here to jump on to. Chris, thank you very much for joining me, man. We'll see you on the next one.
Anytime. Thanks.
Yep. See ya. All right, guys. So we're doing a trading battle here outside of, it's not on this stream. We're going to be jumping over to the next stream. I'm going to drop the link here in the chat for you guys. If you want to do some day trading with us, if you want to watch the charts and trade the post-Fed meeting with me and 2 other veteran traders, we're about to kick off another stream. It's not on here, so this stream is going to end. Click the link that just got dropped in the live stream chat right here. We're going over to the trading battle, which is a sponsored DNA thing, but we're going to be trading live things like S&P 500, Euro dollar, gold, silver, Bitcoin, placing trades in front of a live audience. 2 traders are going head to head. I'm hosting the event and will be commenting on this. So if you are not already, do not miss this free to attend. Yeah, totally free. Somebody said this is a free. 100%. It's free to join. Just click the link that's just been dropped in the chat to join the trading battle. We'll continue commentary on what we just heard from the Fed. The show is not over. We're just moving to a different stream on their channel to host the trading battle. So join me over there. Click that link. I'm going over there now, and we are starting in just a moment. So thank you guys for watching on this side, and I will see you in trading battle in just a second. If it's easier for you, just search up the trading battle, 3 words, on YouTube, and you'll find the stream. We're kicking it off here in 1 minute. So here we go. See you on the trading battle. It's going to be fun. See you guys.
Thank you for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want to get put on the nice list this year? Then make sure you check out the A1 Stock Box. That's all for today, everyone. We'll see you tomorrow. Ho, 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 ho.